I think the biggest thing to realize is that the baseline for price inflation is not zero. It's negative because on average we get more productive at things, not less productive. And therefore, the thing you always want to focus on, the question you want to ask with most financial assets is, what is my rate of dilution? If I'm holding dollars or any other currency, look up the long-term growth rate of that thing you're holding, offset by whatever interest rate you expect to get on that holding, and that's your net dilution. So if your money supply is growing up by 7% a year and you're getting a 4% interest rate, you're getting diluted by an average of 3% per year. Your share of the network, aside from new income that you're actively working for, just your passive share of the network is shrinking. And it means someone else is growing. Someone else is getting that.
Most people think inflation is just a pesky price hike, but the truth is way darker. Your money is being stealthily vaporized. In a sane world, prices should drop over time. Technology and efficiency should make everything cheaper. But thanks to endless money printing, your cash is melting faster than an ice cream cone in hell. As Lyn Alden reveals in the interview, the baseline for price inflation isn't zero, it's negative. We should be living in a world where productivity gains make things cheaper, but the system is rigged to keep expanding the money supply faster than your savings can keep up. Here's the nightmare math. If money supply grows at 7%, but your bank gives you 4%, you're still losing 3% per year, your financial future shrinking like a raisin in the sun. Who profits? The usual suspects: banks, corporations, and politicians, first in line to grab the freshly printed cash. This is why Bitcoin isn't just another asset, it's a rebellion. A finite, decentralized escape hatch from a system designed to bleed you dry. The real question isn't whether you can afford Bitcoin, it's whether you can afford to ignore it while the market roller coaster launches it into the stratosphere. Let's watch clips from Lyn Alden's latest interview to gain more insight. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
How is the system broken? How did we get here?
So I try to describe it as a technological problem first and foremost, but that doesn't necessarily require really deep technical understanding. There's just some key points. And so I kind of separate the financial history into kind of three main eras. So the first era was pre-telegraph. That's when everything was analog. And so there were monetary technologies, things like coinage, things like paper and the printing press. We don't really think of them as technologies today, but at the time they certainly were these new technologies that allowed basically forms of ownership and money to move around quicker and transactions to move around quicker. But once they invented the telegraphs, that was the 1830s, and then by the 1860s, we had cross-Atlantic cables, cross-continental cables, and you could talk almost instantly or send low bandwidth signals almost instantly around the world. And that means you could do transactions almost instantly around the world. And the way that I describe the problem is that opened up a really big mismatch between transaction speeds, which could now just go around the speed of light almost, and settlement speeds, which at the time were still physical gold and other physical valuables. And the kind of the main way that they bridged that gap was to have a big centralized ledger. So either big commercial banks or in many cases a central bank that all the commercial banks build on top of. And that becomes a trusted layer that everybody has to use to bridge between settlements and transactions. And whenever there's a really big centralized honeypot, it's prone to manipulation. It's prone to people misusing it for various reasons and kind of breaking that trust. And the reason I look at that through that technological lens is because I think for the first time in a very long time that gap is closed. Because Bitcoin it represents multiple things, but in this context it represents the invention of fast settlements. So after basically a century and a half, we finally had the settlement side catch up to the transaction side. And that, of course, took a lot more bandwidth, a lot more inventions that just had to be created over the course of that period of time. And so I would say money's been broken. It's partially because of individuals making decisions. So we can point to, the creation of this central bank or this politician making this decision at this time. Those are all true. But I think the structural underlying problem for why it's basically broken in every single country, and it's been broken for a very long time, is because we've kind of lived through this technological mismatch And that's made it very hard. Basically, all the incentives in front of politicians and central bankers and policymakers in general aired toward making it very easy for them to break the trust and create problems. So structural inflation, the underlying cause is growth in the money supply on a sustained basis. Now, you can have temporary causes of inflation, of price inflation, things like, for example, a war or a shortage, or other, basically anything that harms productivity can make prices go up temporarily in a certain area. They will generally, if the money supply growth itself is not the issue, those prices will come down in time, and or they will lower the prices of something else that people aren't buying because they have to prioritize buying this thing that has gone up in price, if it's something core like food or shelter. But in order to get sustained, persistent price increases like we see today and for a very long time, it requires that the money supply itself is increasing. That's an axiom that's true everywhere. And that primarily hits us in one of two ways. The way we normally think of it is consumer prices go up, or a typical basket of what a person might buy in a given year. That basket is increasing. And they're all happening at different rates. I mean, things like hospital services might be going up faster than the official inflation rates, while things like electronics might actually still be deflating because they're getting more productive even faster than the money supply is growing. And so they actually have a negative inflation rate in some cases. And the mix of all that together is we find that the average price of living a year of our lives, much like last year, is higher, which means that then Americans have to go out and try to get a raise, try to kind of keep up with that. The other way that it can manifest is it can show up in asset price inflation, which is normally not very captured in consumer prices. But basically, when you have a period of rapid money supply growth, but also pretty high productivity growth, so if the economy is doing a pretty good job of keeping energy well supplied and other goods and services flowing pretty readily, then not all of that money supply growth is going to necessarily show up in prices at the same rate. And a lot of that surplus will show up in things like equity prices, housing prices, gold going up and kind of capturing some of that, maybe the modern era of Bitcoin now. But looking at history, we basically any of these more monetary type of assets that are primarily owned by the wealthier, the upper middle class and the middle class, those assets tend to capture a lot of that growth. But then that can make it harder for new entrants to want to buy those assets, which is particularly relevant for housing. So at the end of the day, it all comes back down to money supply growth, because that's a necessary part of, if we see inflation like on a persistent basis, it has to be because the money supply itself is also growing.
For 150 years, they've trapped us in a rigged system. The telegraph gave instant communication, but banks kept settlements slow, maintaining their stranglehold on your wealth. Every financial crisis, every bailout, every time your paycheck buys less, it's all by design. Bitcoin is the antidote to this poison. While central banks print trillions to bail out Wall Street, your savings get vaporized. Housing, healthcare, these aren't just price hikes, they're legalized robbery through inflation. The Cantillon effect ensures bankers and politicians get rich while you fight for scraps. But here's where it gets explosive. BlackRock, Fidelity, and even nation-states are now piling into Bitcoin. Why? Because they see the writing on the wall. The dollar's dominance is crumbling, with BRICS nations openly plotting a gold-backed alternative. Meanwhile, Bitcoin's fixed supply makes it the ultimate hedge against monetary collapse. The elites hate this. That's why they spread FUD about crypto, while quietly accumulating Bitcoin themselves. They know what's coming, a global financial reset that will vaporize weak currencies. Will you be on the right side of history? Or will you cling to dying fiat as it burns? Let's watch more clips from the interview.
I think when we look at a couple key things like house price inflation, as well as other big expenses like healthcare inflation, these things have generally been above trend compared to what we think of as inflation, CPI. And those are some of the biggest expenses that people have. And so back in like the 70s, for example, interest rates were quite high. And so in many cases, saving in bonds, especially by the time they got to the 80s, was considered more attractive. And you wouldn't necessarily want to go out and buy a house just for savings if you're going to pay a mortgage rate of like 10% or higher in many cases. So the average house price was lower, and people primarily looked at them as a utility thing. You need shelter, so you buy a house. As interest rates came structurally down, and as we went through multiple decades of persistent currency debasement and people realizing that if the money's weak, they have to save in other things. They have to monetize other scarcer assets if they want to preserve their purchasing power. One of the key things they go into is real estate. That's in addition to things like equities or gold or other financial assets, but real estate's obviously a very large and popular one. And so people can buy second homes and leave them empty. People can, do all sorts of things. And they're willing to pay pretty high prices because if you're wealthy and you can get a 3% mortgage, while money supply is historically growing at 7% a year, many of them will pay up quite a bit for a house and then price out more price-sensitive buyers. And so that has been a pretty persistent issue against the middle class and overall household formation and key metrics like how many hours of work it takes to afford a house. And some people will push back on that and say, well, houses have gotten bigger on average. Then the kind of the counter pushback is that they've also in many ways gotten lower quality per square foot. So if you knock on the wall of your new construction today, it's going to sound like balsa wood compared to what a new construction would have been like years ago. And of course, you've gotten better at engineering, so some things work better, of course. But on average, it just takes more work to afford a similar size and quality of house than it did some decades ago, and therefore it often takes two incomes, and people can feel like they're having trouble getting ahead. But overall, the kind of the main issue basically relates to the Cantillon effect. So the closer you are to the source of money creation, generally the more you benefit from this perpetually expanding money supply system. And so, for example, if you're a large bank, if you're a large corporation, if you're high up in these types of entities, or otherwise, if you're wealthy and you're able to access cheap credit for very long periods of time, you're kind of perpetually, in a self-reinforcing way, advantaged from that system. You're able to basically short fiat currency. You borrow fiat currency at a lower rate of interest than its supply growth rate. So you're shorting something that's losing its value, and you can go out and buy all sorts of financial assets, buy cash flow producing businesses, buy all sorts of things. Whereas if you're generally on the lower end of the income and wealth spectrum, it's harder for you to access credit. It's very expensive when you do get credit. And then you can, ironically, you pay more for banking services just because you're dealing with fees and problems there. So it kind of becomes self-reinforcing to the downside unless you can have a big jolt, like education or something that can help you kind of break out of that. And while there's always some degree of wealth concentration in any system, for a variety of different reasons, I think the kind we're more worried about is what we perceive as unfair wealth concentration. So someone invents a new widget that makes everyone's lives better. Most people they don't lose sleep over the fact that that person became quite wealthy because, sure, they got wealthy, but they made everyone else essentially wealthier too. I think where we notice the problem is, especially in the financial sector, when you kind of look and say, well, is that person really adding to society, or are they kind of they kind of put themselves in a kind of parasitic position near the core of the system, so they're able to get out disproportionate benefits from that they wouldn't have in a more sound money system. The other big factor is that if you're really close to power, and power has a flexible monetary ledger that you can really print money, then you can get selective goodies or bailouts. And so, for example, for decades, the most lucrative thing you could do was go to Wall Street, unless you're going to be Bill Gates or something and be an outlier inventor or something. The much easier path to riches was go to Wall Street, work in finance, and then eventually when that blew up, when they over-leveraged themselves and blew up, they had enough pull with the government to get themselves largely bailed out, either in terms of direct capital injection or being given very low cost of capital, artificially low, right at the time when everything's cheap and no one else has access to low cost credit. And so that combination, and is basically that the rich kind of keep getting richer and finding more ways to influence politicians to help them stay rich and get richer. Whereas if you're on the wrong side of that, your influence is weaker and you're working against these things that are kind of self-sustaining against you.
The financial system we operate in today is shaped by the relentless expansion of the money supply, which, as Lyn Alden discusses, leads to a consistent erosion of purchasing power over time. While productivity and technological advances should ideally lead to cheaper goods and services, the reality is that inflation, driven by government interventions and money printing, causes the opposite effect. The result? A system where wealth is continually transferred to those closest to new money, banks, corporations, and governments, leaving the average person with less. This structural problem is highlighted in the current market dynamics, with the US dollar facing a crisis of confidence. As the dollar weakens, Bitcoin, often referred to as digital gold, is increasingly seen as a potential safe haven. Much like gold has done in times of economic instability, Bitcoin offers a way for investors to protect their wealth from the devaluation of traditional currencies. This growing trend suggests that Bitcoin could eventually bridge the gap with gold's $22 trillion market cap, serving as a store of value in an environment where the US dollar continues to lose its dominance. Lyn Alden's insights on inflation and the Cantillon effect resonate with the growing appeal of Bitcoin. As central banks continue their money printing practices, Bitcoin provides an alternative that escapes the rigged system, giving individuals the power to safeguard their wealth against inflation and the systemic risks inherent in traditional financial structures. As we face the possibility of a dollar collapse, holding Bitcoin may be more than just an investment. It's a critical step toward financial freedom. Thanks for watching. Please share this video, hit the like button, and don't forget to subscribe.